The economy grew 3.4% last quarter. Ontario rents are still down 5.8% year over year. Both are true. Welcome back to Smart Real Estate. I'm Addy Saeed.
I'm Ribhu Rampersad. Addy's on the acquisitions and broker side. I cover mortgage and CMHC financing. And today we've got a genuinely packed episode.
We're doing a full deep dive this week. Canada's economy, the Ontario rental market, a research project we did ourselves on the Landlord and Tenant Board, 2 major deals, and a quick read on federal rail spending.
If you want the full breakdown after this, everything we covered today and more is free at learninvestmanage.com. Sign up and you'll get access to the school community too.
Let's start with the headlines. Statistics Canada's May GDP report came in at plus 0.3%, stronger than economists expected. And it's not just May. The early estimate for June points to another 0.2% gain. RBC's economists say if you analyze that, Q2 growth comes in around 3.4%, more than a full point above their own 2.2% forecast.
That's a meaningful beat. And it wasn't one sector carrying the whole thing. Goods producing industries were up 0.6% in May. Manufacturing, construction, mining, and oil and gas all contributed.
Construction specifically caught my eye, up 0.8% in May, on top of 1.3% in April. RBC ties that to engineering and other construction, plus residential building specifically.
From where I sit, that residential construction number matters for financing conversations. When builders are pulling permits and moving projects forward, that's a signal lenders read as confidence returning to the sector.
And real estate and rental and leasing output were up 0.4% in May. That's the fourth straight monthly gain. RBC tied it to strong home resale volumes during this period.
4 months in a row is a part that I'd flag. That's not a blip.
But let's not get ahead of ourselves. RBC's own risk section calls out escalating trade tensions and the new U.S. tariff announcements as real downside, particularly for trade-exposed industries. Wholesale trade already posted a decline in the June advance estimates.
So the bear case here is straightforward. This is a good quarter riding on numbers that, by RBC's own admission, notoriously revision prone. 1 week print doesn't undo the trend, but one strong quarter doesn't guarantee the next one either.
So the bottom line is the Canadian economy bounced back harder than expected in Q2, and real estate specifically was part of that story, not just the riding along. So a couple of great takeaways here. Q2 2026 GDP tracking at 3.4% annualized, over a point above RBC's forecast. Real estate and rental output, fourth consecutive monthly gain in May, and construction momentum is building, up 0.8% in May on top of April's 1.3%. Something worth watching, trade tensions and new U.S. tariff remain a real downward risk for H2 in 2026. And also, monthly GDP and advanced estimates are revision prone. Don't overweight one print. Wholesale trade already showing cracks in June advanced data. Now, let's zoom into rents, because this is where it gets complicated. Urbanation's Q2 2026 numbers are out, and Ontario is not leading the pack, at least not the way we'd like. National average rents, $2,030, down 4.6% year over year. Ontario came in at $2,229, down 5.8%. That's steeper than BC, Quebec, and Alberta.
And it's not just apartments. Break it down by rental type, and condos are down 6.5% year over year nationally. Houses down 7.6%. 2-year numbers are worse. Condo rents down almost 11%. Houses down nearly 14% since 2024.
And here's the twist though. Supply isn't slowing down in Ontario. Apartments under construction here are up 4.1% year over year.
There's actually a national data point worth putting next to that. Separate from Urbanation, Q2 2026 vacancy data shows the national apartment vacancy rate fell 40 basis points to 4.7%. First decline after 9 straight quarters of increases. Demand is starting to catch up with all the new supply that's coming online.
So you've got two things happening at once. Ontario rents falling faster than the rest of the country, but vacancy nationally tightening for the first time in over 2 years.
For anyone financing a deal right now, that combination matters. Softer in-place rents make today's underwriting more conservative. But if vacancy is genuinely turning, that's the kind of signal that supports rent growth assumptions further out.
And I'd be careful with that read though. 1 quarter of vacancy tightening isn't a trend yet. An Ontario supply pipeline, that's 4.1% increase in construction, is still leading into a market where rents are already soft. So a couple of great takeaways here. Ontario average rent $2,229, which is down 5.8% year over year. That's steeper than BC, Alberta, and Quebec. National apartment vacancy fell to 4.7% in Q2 2026, and that's the first decline in over 2 years. Ontario apartments under construction are up 4.1% year over year, more supply landing into a soft market. Something worth watching. 2-year cumulative rent declines are steep. Condos are down 11, houses are down 14% nationally. And 1 quarter of vacancy tightening doesn't confirm a trend. Watch Q3 for confirmation. A new Ontario supply could pressure rents further before any recovery takes a hold. So this next one is our own research. We pulled every order that Landlord and Tenant Board released between January and May of this year, over 40,000 records, and we ran the numbers ourselves. A few things that stood out. First, 84% of all cases at the LTB were filed by landlords, not tenants.
Before anyone reads too much into that, it's worth explaining why. Arrears and holdover applications are structurally landlord initiated. A tenant doesn't file to evict themselves. So that number partly reflects how the system is built, not necessarily who's in the right more often.
Fair. And here's the number underneath that one. Of those landlord filings, 58.6% were L1, non-payment of rent, not damage, not bad behavior, just arrears.
That's the one that matters most for underwriting. Rent arrears at the LTV level isn't a tail risk event in this data. It's the single largest category of filing. If you're running a multifamily portfolio in Ontario, budgeting for arrears exposure isn't optional.
So two more numbers. Almost 1 in 6 orders, 16%, were decided ex parte. No hearing, nobody in the room, ruled on paper.
And geographically, Toronto and the old amalgamated boroughs, which is Etobicoke, North York, Scarborough, York, and East York, account for almost 3 in 10 orders across the entire province.
One city's footprint carrying almost a third of Ontario's tenancy caseload. That's a density story as much as anything else.
It is worth flagging the data itself is a couple months old at this point. It runs through May. We're treating this as a trend read on where the caseload sits through the first half of the year, not breaking news.
So key takeaways, 84% of LTB cases this year were landlord filed, 58.6% of those were non-payment of rent. Almost 1 in 6, 16% were decided ex parte without even having a hearing. And Toronto and the old boroughs account for nearly 3 in 10 orders province-wide. Something worth watching. High ex parte rates raise access to justice questions worth watching on both sides of the table. The landlord-filed ratio reflects filing structure, not necessarily conduct. Don't overread it. And data runs through May 2026. Treat as H1 trend, not as a current week signal. So let's talk about a deal that I actually like the shape of. Lankin Investment just picked up an 80-unit building at 33 Dawson Road in Guelph. Off-market, existing relationship with the vendor, CMHC financing. Price wasn't disclosed, but the details that matter. In-place rents are running at about 50% below Guelph averages.
That CMHC piece is worth pausing on. A value-add acquisition with CMHC in the capital stack tells you the lender saw enough stability in the existing cash flow and the asset to get comfortable.
7-story concrete building built early 70s, elevator, boiler, generator, hot water, security, all updated over the years. But the unit interiors are original. That's the value-add runaway right now.
And the market underneath it backs the thesis. Guelph's population is up over 10% in 3 years. Historical vacancy under 2%.
Yeah, 2-bedroom rents in Guelph are up 32% over the past 5 years, and Lankin president told Renex that their sweet spot is 95 to 97% occupancy, high enough to be healthy, low enough that they're still capturing turnover.
15 to 20% annual turnover is what lets them close that 30 to 50% gap between in-place and market rents. That's the whole playbook. Buy rent control 60s to 80s stock, renovate on turnover, and capture the spread.
Something worth noting, Lankin doesn't touch new builds in Ontario anymore. Rents that are already at market, no gap to capture.
One risk at flag, Lankin's own president expects cap rates to compress significantly by 2028 and 2029 as institutional buyers pile back in. Deals like this one get more competitive and more expensive to find from here.
So a couple of key takeaways, 80-unit Guelph acquisition, in-place rents about 50% below market rents, and CMHC finance. Lankin's model is to pick up properties that are built in the 60s, 70s, and 80s, rent-controlled stock, 30 to 50% rent cap, captured via 15 to 20% annual turnover. Guelph fundamentals support it, the population to plus 10% in the past 3 years, and historical vacancy is under 2%. Something worth watching, cap rate compression expected by 2028-2029 as institutional capital returns. Windows may be narrowing. And value-add execution risk. So original unit interior finishes means real capex risk ahead, not just paper upside. And Lankin model depends on rent control gaps persisting. A policy shift changes the math significantly. So last major story of the week, and it's a big one. H&R REIT, one of Canada's largest diversified REITs, is being acquired and broken into different parts. $6.7 billion deal led by Go Residential REIT. Unit holders get $4.28 billion in cash plus 0.5688 Go REIT unit per unit held. Based on Go's closing price, that value is around $12.01 a unit. H&R's unit holder end up owning about 67% of the combined entity.
What actually happens to the portfolio is the interesting part. H&R's residential assets, the Sunbelt US and New York apartments, get folded into Go REIT. That creates Canada's second largest publicly traded residential REIT, over 13,300 suites across 8 markets.
Yeah, and everything that isn't residential gets peeled off separately. Blackstone takes some of the Canadian industrial book. Crestpoint and PSP pick up properties where they already hold co-ownership stakes. CRAL, a company controlled by H&R's own executive chairman's family, takes the remaining non-core assets.
From a capital markets lens, this is a pure play story. Diversified REITs have traded at a discount to net asset value for years because the market doesn't know how to price a mixed bag of residential and industrial in one wrapper. Breaking it into specialized vehicles is meant to close that gap.
It's also a signal about where institutional capital wants exposure right now, residential specifically. Blackstone, PSP, Crestpoint, none of them are buying more residential here. They're taking the industrial pieces off the table.
The deal still needs unit holder and regulatory approval before it closes, expected late Q4. And the consideration is partly in Go REIT units. So the ultimate value to H&R unit holders moves with Go's own unit price between now and closing.
That's the real risk for anyone holding H&R units through this. You're not locking in $12.01. You're locking in a formula that depends on Go REIT stock prices holding up. So a couple of takeaways. $6.7 billion deal creates Canada's second largest publicly traded residential REIT, 13,300 plus suites. By the way, number one is Cap REIT. Non-residential assets split separately into Blackstone, Crestpoint, PSP Investments, and CRAL, and signals institutional presence of pure play residential over diversified REIT structures. Something worth watching. Deal consideration is partly in Go REIT's units. Value to H&R unit holder isn't fixed until closed. Still subject to unit holder and regulatory approval, expected late Q4. And also watch whether the pure play thesis actually closes the NAV discount post-close. Last one, and we're keeping this brief because the direct Ontario's connection is limited. Ottawa is putting $1.9 billion in replacing Via Rail's locomotive fleet and building a new assembly plant.
The plant of the 1,200 jobs land in Montreal, and the new fleet specifically excludes the Windsor to Quebec City corridor. That's Toronto, Kitchener, and London. That corridor is getting the separate Alto high-speed rail project instead, which is still years out.
So don't mistake this for the Ontario catalyst. It isn't. It's a signal. Federal capital is flowing back into rail infrastructure, and over the long horizon, transit access is one of the things that reshapes land values. Alto is the one that is to watch. A couple of takeaways. $1.9 billion fleet renewal explicitly excludes the Windsor, Quebec corridor, Ontario's busiest line. Alto's high-speed rail, not this announcement, is the actual long horizon Ontario catalyst, and federal rail investment signals renewed commitment to the sector, worth tracking over years, not over months. So everything's covered on this episode is free at learninvestmanage.com. So in closing, there's three themes from this episode. Macro strength, local softness. The national economy and vacancy are improving, but Ontario rents are still falling faster than the rest of the country. Consolidation and specialization, from Lankin's disciplined value add model to H&R's breakup into a pure play residential REIT, capital is picking its lane. And know your caseload. The LTB data shows arrears, not conflict, drives most filing. Underwriting has to reflect that reality. Couple of episode takeaways. Q2 GDP tracking at 3.4% annualized, stronger than expected. Real estate is the contributing factor. Ontario rents down 5.8% year over year, even as national vacancies show its first tightening in 2 years. 58.6% of LTB landlord filings are simple rent arrears. Budget for it. Don't treat it as a tail risk. Lankin's Guelph deal and the H&R Go REIT breakup both point to disciplined, focused capital deployment. Via Rail's $1.9 billion is a long horizon federal signal, not an Ontario catalyst. Watch Alto instead. That's the show, Smarties. If there's one thing to take away from this week, it's that the headlines and the ground level data aren't always telling the same story. GDP is up, but Ontario rents are still under pressure. The gap is where the opportunity and the risk both live.
Everything we talked about today, plus the tools to run your own numbers, is free at landlord-filed.com. Sign up and you'll get an invite to our school community too.
We'll see you next week, Smarties. Addy Saeed is a licensed real estate broker with Remax Gold Realty, RICO license 47353346, founder and general manager of Westcliff Living, and an OSC registered dealing rep. Ribhu Rampersad is a licensed mortgage broker, level 2 with BLD Financial, DLC license 12360. The host may reference companies and entities in which they hold ownership or financial interest, including Westcliff Asset Management, Westcliff Living, Olympus Properties Group, and Finance P. Listeners should be aware of these relationships when evaluating any commentary in these episodes.
This podcast is for informational and educational purposes only. Nothing in this episode constitutes financial, legal, mortgage, or investment advice. Always conduct your own due diligence and consult qualified professionals before making any investment decision. Past performance is not indicative of future results.